Hi, this is a quick video for you about price elasticity of demand, and what we're going to look at in particular is an understanding of this concept, the formula for calculating it, the distinction between price elastic and price inelastic demand, and then how price elasticity of demand affects how price changes impact on total revenue. So let's look at what PED is. So according to the law of demand, we know that when the price of a product falls, the demand for it will extend. There's a negative relationship between price and quantity demanded, but we don't actually know by how much demand will extend by when price falls, or if price was to rise, how much will demand contract by? We don't actually know the magnitude of that change. So to find out the magnitude of the demand change, we need to know what the product's price elasticity of demand is. PED measures the gradient of the demand curve. So let's pin down this term price elasticity of demand. How would you define it? I would define it as follows. Price elasticity of demand measures the responsiveness of demand to a change in quantity demanded. So we know that the demand for some products are more price sensitive or price elastic than the demand for other products. Price elasticity of demand, as I say, it measures the responsiveness of quantity demanded to a change in the price. So if we look at the chart there, demand curve D1, which is the orange one, is relatively steep. So a price fall from P1 to P2 only causes demand to extend from Q1 to Q2. So that's a price inelastic demand response. Demand isn't that stretchy, it's not moved by that much. On the other hand, if you look at the same price change from P1 to P2, the same price cut, on demand curve D2, which is more price elastic, more price sensitive demand, you get a much bigger extension in demand from Q1 to Q3. So let's look at the formula for calculating price elasticity of demand. The formula is that you calculate the percentage change in quantity demanded and then divide it by the percentage change in price. So two important things to bear in mind here. First of all, there's no percentage sign at the end of this. This is quite a common mistake. Price elasticity of demand figures aren't percentages, although you use percentages to calculate a PED number. So PEDs are numbers, they're not percentages. That's point one. Don't add don't multiply by 100 at the end. Now the second thing is just a recap of GCSE maths. Some students struggle with actually calculating percentages. So what I would urge you to do is to show you working and calculate a percentage change as follows. So calculate what the actual change is, then divide it by the original, then multiply by 100. So let's take an example of price elasticity of demand in practice. In March 2004, the price of a bottle of vodka fell by 36% in Finland because the government decided to cut the excise duty rate on vodka. After the fall in price, the demand for vodka in Finland extended by 20%. So this implies that the price elasticity of demand for vodka in Finland was minus 0.55. Where do we get that figure from? Well, basically, we look at the change in demand, which was plus 20, and then we divide that by minus 36. So plus 20 divided by minus 36 equals minus 0.55. So, you might think to yourself, well, what does that mean? Well, this price elasticity of demand figure implies that for every 1% change in price, the demand for vodka will change in the opposite direction by just over half a percentage point. And this proves that the demand for vodka in Finland is price inelastic, which basically means that finished demand for vodka isn't particularly price sensitive. They'll almost buy it regardless of price, probably because if you drink vodka, you can get addicted to it. So when price goes up, you've got not much choice really, I guess, but to keep on paying a higher price and carry on demanding the stuff. So we could illustrate this using a supply and demand diagram. So the original equilibrium was P1, Q1. Supply increases because the Finnish government cut indirect tax. So the decrease in price from P1 to P2 caused demand to extend. So the equilibrium quantity rose from Q1 to Q2. So if you put the figures into the formula, you can see that the PD value is minus 0.55. So I've asked a question there, why are all PD figures minus numbers? The answer is the demand curve slopes downwards due to the law of demand. So let's look now at the distinction between price elastic and price inelastic demand. So let's look at price elastic demand first. Products that have a price elastic demand have a PD that's above 1. This is ignoring the minus sign. What I mean by this is that all PD numbers are negative because the demand curve slopes downwards from left to right. So what we're saying there in effect is that if the PD is a whole number or more, then the demand you would say is price elastic, in that the percentage change in quantity demanded is greater than the percentage change in price that created it. Another way of looking at it is price elastic demand indicates that price changes have a more than proportionate effect on quantity demanded. So using this diagram here, if the price of a tin of budget Tesco lager goes up from 50p to 60p, the demand for this product you might contract from 100 to 50 units. So if we actually calculated the PED for the budget lager on the basis of these figures, you might want to just pause the video now and have a go at that. Okay, just to see if you've got it right. The percentage change in quantity demanded, well, demand falls by 50 from 100 to 50. The original is 100 multiplied by 100, so we get a 50% fall in quantity demanded. And that's being created by the change in price. So price has gone from 50p to 60p. That's an increase of 10p on an original of 50p. So that's a 20% increase. So if you were to put into your calculator minus 50 divided by plus 20, you get the answer minus 2.5. So that's an example of price elastic demand because it's greater than 1. In this case, what that figure means is that for every 1% change in price, demand changes in the opposite direction by 2.5%. So now we'll turn our attention to price inelastic demand. Products that have got a price inelastic demand have got a PD value that's less than 1. So what that means is that the percentage change in quantity demanded is less than the percentage change in price that created it. Or putting it another way, when demand is price inelastic, the price change creates a less than proportionate change in quantity demanded. Why is this? Well, basically on products that have got a price inelastic demand, when the price goes up, most consumers accept the price increase, they carry on purchasing, and it's only a small minority who choose to give up on this product and stop consuming. So basically you get quite a big price increase, creating a proportionately smaller fall in quantity demanded. So the demand curve there is supposed to show a private school that originally charges fees of £30,000 a year and manages to get 1,000 students applying. What happens is that the school decides to raise price to exploit low price elasticity of demand. So they raise their fees from 30,000 to 36,000 a year. And due to price inelastic demand, that only results in a fall in the number of people applying from 1,000 to 950. So if we were to calculate the price elasticity of demand, maybe you should do that. Pause the video now, have a go at it. Okay, let's just check, see if you've got it right. So the change in quantity demanded was, well, the actual change was a fall of 50 on an original of 1,000, so that's a fall of 5%. The change in price went up from 30 to 36, so that's an increase of 6,000 on an original of 30,000, so that's a 20% increase. So then to calculate the price elasticity of demand, you divide -5 by +20. So we can see that that's straight off that's a quarter. So it's minus 0.25. So again, what that indicates is that for every 1% change in price, demand will change in the opposite direction by a quarter of 1%. So demand isn't that stretchy. It's not that responsive. It's not particularly changeable when price changes rather. Okay, so what we're going to look at now is total revenue, price elasticity of demand, and price changes. This is quite an important topic. So I think the first thing that we've got to do is just make sure you know what total revenue is. Total revenue is the income generated by a firm from selling its product, either a good or a service. So we've got a football club there. What would the football club's total revenue be from spectators? Well, answer, it will be the number of people coming along to the match. That would be the quantity, multiplied by the average price that each of those spectators paid for their ticket. So total revenue then is equal to price, P, multiplied by the quantity sold. So you can abbreviate this to TR is equal to P times Q. Is total revenue the same as profit? No, it's not. Many people get this confused. Profit is equal to total revenue minus total cost. So to get at the football club's profit, what you would have to do is to take off the football club's costs. So from their revenue. So the main one obviously would be the cost to the football club of paying for wages and also taxes that they pay to the local council. Taxation is a very, very important business cost. In some cases, it can be the biggest cost that a business faces. So we'll look now at price elasticity of demand and total revenue. So as we know, two factors affect total revenue, price and quantity demanded. So due to the law of demand, price and quantity move in opposite directions. Therefore, the impacts of a price increase on total revenue will depend on what happens to quantity demanded relative to the price change. So if this nightclub, the one that's shown here, increased its prices, would its total revenue rise or fall? Would obviously putting up prices would lead to a fall in quantity demanded. That's what the law of demand says. But the magnitude of that fall in quantity demanded would determine whether the price increase worked or not in terms of its ability to raise extra revenue. And the magnitude of the change in demand following the price change would obviously depend on the price elasticity of demand for the clubbers that wanted to go to this nightclub. So so at the heart of this then is would the percentage fall in quantity demanded be greater or less than the percentage increase in price? That's the question. And obviously the answer would depend on what the product's price elasticity of demand is. So let's look first of all at how price changes affect total revenue if demand is price inelastic. Okay, so let's look first of all at how an increase in price might affect the total revenue generated on a price inelastic demand situation. So the general rule is increasing price on a price inelastic product will always increase total revenue. This is because the increase in price is proportionately greater than the fall in quantity demanded. So what happens here then is that you put the price up by quite a big margin. Some customers stop buying, but this is more than made up for the fact that many, many more consumers continue to purchase, but they're now doing at a far higher price than they used to. So that's why revenue goes up. So you'll see here from the diagram, originally the old revenue that we were making was P1 times Q1. We then increased price by quite a big margin from P1 to P2. And as a result of that, there's only a very modest contraction of demand from Q1 to Q2. So what happens here then is we lose the red area of revenue because there are slightly fewer customers buying. But then we've also got to take into account that the vast majority of our customers have stayed loyal and they're now paying a much higher price. So that's shown by the green area there. So you can see in this situation, when you put price up on a price inelastic product, total revenue will increase because the green area generated by existing customers paying higher prices is greater than the loss in revenue created by some customers uh, ceasing purchasing the product because it's become more expensive. So you can see this in the UK with trains. A lot of the train companies have monopolies. They provide an essential service, or they did, for commuters. So when they put price up, you might get a few commuters who maybe decide to quit their job and go and do something else with their lives, and so they don't need to buy a train ticket anymore. That would be the red area. But the vast majority of people aren't brave enough to do that, and they'll just keep on coughing up paying for this more expensive ticket. So the net effect on the train company's revenue is that revenue goes up because there's more people that accept the price increase than there are who reject it. So let's look now at what happens when you cut price on a price inelastic product. So as we know, cutting price on a price inelastic product will always result in a fall in total revenue. That's because the percentage fall in price is always going to be more than the percentage increase in quantity demanded. So an example of this happened with Morecambe Football Club. Um, in 2017-18, the club charged an average of £20 per ticket for a home match, and they achieved on average an attendance of around about 1,900 fans per game. The following season, ticket prices were cut to £15 from 20 quid, and that caused only a small increase in quantity demanded. Only an extra 100 fans turned up to watch the game. So that's implying then that we've got quite a price inelastic demand reaction. 100 extra fans on an original attendance of 1,900 works out to be a 5.26% increase in attendance. The change in price will cut a fiver off the ticket, so minus 5 divided by the original 20, so that's a 25% cut in ticket prices. So the price elasticity of demand there is plus 5.26 divided by minus 25, so that gives us an elasticity of minus 0.21. So that's definitely price inelastic demand because the figure is less than 1. So what impact did it have on revenue? Well, the old revenue was £20 per ticket multiplied by 1,900 fans, so £38,000 revenue per game. The new revenue, you'll see it fell. They were only charging £15, and that wasn't made up for by enough extra fans. Only 2,000 fans came. So revenue actually fell from 38,000 to 30,000. So that this obviously begs another question that I've not put on the slide, which is like, why did they do it? And I guess there's two possibilities. The first possibility is that maybe the club thought that they had fans who were more price elastic in their demand for football than they actually were, and maybe they were surprised at the price inelastic demand reaction. Personally, I think that that's unlikely because football fans are notoriously loyal. So that for me implies low price elasticity of demand rather than high price elasticity of demand. The other reason is just, yeah, maybe they did realize it was going to cause revenue to fall, but they didn't really care about that. Maybe the owners weren't trying to maximize profits. Maybe they were trying to maximize the number of home wins because the owners were fans. their primary goal is to see the club do well rather than to make as much profit as possible. This is obviously quite common in football. Okay, let's turn our attention now to price elastic demand. So when price is increased on a product that has got a price elastic demand, total revenue will fall. This is because the price increase creates a proportionately bigger fall in quantity demanded. So the extra revenue from some customers paying a higher price is not enough to compensate for the fall in revenue caused by the fact that there are now fewer customers buying. So if we look at the demand curve there, obviously we're starting off with the price of P1 and QD is Q1. So the total revenue is a long rectangular area, P1 Q1. They go for the price increase in price from P1 to P2. That creates a massive contraction of demand from Q1 to Q2. So let's look at this in terms of areas. Yeah, you put your price up. Some of your customers accept the price increase, so you'll generate a bit of extra revenue from them. But that won't be enough to compensate for the fall in revenue that results from the fact that a large number of your customers rejected your price increase and elected to stop purchasing your product. So you can see here that the net effect on revenue is negative. Total revenue will fall because the area of revenue gain from the price increase, which is the green area, is less than the area of revenue lost because a high proportion of your customers gave up on you and purchased something else instead. So what then should firms do that sell products that have got a price elastic demand? The answer is that these firms, if they want to maximize revenue, they should cut their prices, because if they do that, total revenue will go up. If you cut price on a price elastic product, total revenue will always go up. So you might think about a famous pub chain that has particularly price sensitive customers. This pub chain knows that they can sell 100 cooked breakfasts every day at a price of £5, generating a revenue of £500 a day. The pub's clientele, as we say, it's quite price sensitive. So if they cut price to £4, they might be able to double their sales to 200 breakfasts today. So on the basis of those figures, the PD for a breakfast is -5. In this case, the price cut will cause the pub's breakfast revenue to rise from £500 to £800 per day. So you can see here that it's really, really important. If you sell a price elastic product, if you want to increase total revenue, you cut price, because the increase in quantity demanded is going to be proportionately greater than the price cut. So just a quick recap to finish. So if you're selling a price inelastic product and you want to make revenue go up, then you raise price. On the other hand, if you're selling a price elastic product and you want to make more revenue, then you cut price. And then, of course, that revenue is equal to price times quantity. So that's a really, really important thing for you to remember.